Welcome and thank you for standing by. All participants are in a listen-only mode for the duration of today's session. Today's session is being recorded. If you have any objections, you may disconnect at this time. I would now like to turn the call over to your host, Michael from the Census Bureau. Michael, you may begin.
Thank you, Anthony. Good morning, everyone. My name is Michael Simmons, Supervisory Economic Statistician with the U.S. Census Bureau Economic Management Division. The Census team is happy to host a webinar today, and we believe it will be enlightened on the 2024 commercial outlook for business, banks, and international trade, covering anticipated growth levels, interest rates, supply chain recovery, and other factors that will impact capital markets, small businesses, exporters, and the economy. This is a great way to kick off the new year with an enlightening presentation and conversation between the CEO of Secure Finance Network, the Senior Economist of Allianz, and the Acting Associate Administrator of the Small Business Administration's Office of International Trade. Before we begin, I would like to cover a few items. The webinar is being recorded. The recording, transcript, and presentation will be available in about 7 to 10 business days following today's webinar. It will be posted to the Census Academy website as well as the Small Business Administration site. At the end of today's presentation, we will have a Q&A and will address as many questions as possible. Please submit your questions using the Q&A feature located by clicking on the lower right-hand corner of your screen. Also, we have an evaluation that we ask that you complete, and it assists us in planning future webinars to bring you quality content. Now, I believe we're ready to begin with today's subject matter. I will turn it over to Claire Eman with the Small Business Administration, Acting Associate Administrator for International Trade.
Thank you so much, Michael. And welcome everyone to our commercial outlook for 2024. This is, I work in the SBA's Office of International Trade. This is our second year hosting this event, and we're really excited. We have more than 900 people registered. As Michael said, we do have a Q&A feature, and this event is closed to the press. To start off, I would like to thank our guests, Rich Gumbrecht from SFNet and Dan North, the Senior Economist at Allianz. And I'd also like to especially thank those of you that are tuning in live, or if you're watching the recording. I know in the audience we have current and prospective lenders, we have service providers and export counselors, and most importantly, we have small business exporters in the audience who I hope can put the topics that we discuss here today to work in your daily business. So welcome to everyone. Just briefly, before we get to 2024 and the commercial outlook, I want to talk just a little bit about 2023 from an SBA perspective. The United States is experiencing a historic small business boom. This boom continued for the third year in a row with 5.5 million new business applications filed in 2023. There have now been 16 million new business applications filed since 2021. These application numbers for new businesses are really important because small businesses are the backbone of our economy. They are the heartbeat of our communities. The small businesses and small medium-sized businesses create 2/3 of new net jobs, and they generate 40% of our nation's economic output. It's also really exciting and sort of different. This small business boom has really been defined by outsized growth in entrepreneurship among women, Latinos, and Black Americans. So we have seen the fastest creation rate of Black-owned small businesses in 30 years, and we've seen the fastest creation rate of Latino-owned businesses in more than a decade. The SBA has really helped grow and sustain this boom by closing capital access gaps, increasing our outreach to underserved entrepreneurs, and bolstering competition both domestically and abroad. On the capital side, in the past 3 years, the SBA has lent $108 billion to small businesses through its signature 504 and 7A loan programs. And then on the exporting side, which is what my office does, last year my office announced findings from a study that we commissioned. We found that there are 1.3 million small businesses doing some exporting at a volume of $1.1 trillion in exports per year. My office in the SBA has export finance products, including the Export Working Capital Program that's available for businesses looking to export, along with the full range of our other SBA loans. And then the SBA also runs the State Trade Expansion Program, or the STEP program, through our state partners. The STEP program is a really wonderful program that provides grants to small businesses to help them defray the initial costs associated with opening new international markets. To find out more information about STEP, you can always go to sba.gov and just search for STEP, S-E-E-P, to find out who runs the STEP program in your state. So again, we're really happy to be hosting this commercial outlook, and I'm going to turn it over now to Rich Gumbrecht from the Secured Finance Network. The SBA and SFNet we started working together last year just to help educate audiences on working capital. We know that working capital is really key to international trade and supporting this small business boom. SFNet is one of the lead organizations that's focused on working capital and secured financing industries. So I'm really delighted to turn the presentation over to the SFNet President and CEO, Rich Gumbrecht, for his insights into your priorities for 2024. So over to you, Rich.
Great. Thank you, Claire. And my pleasure to be here. And thanks to everybody for joining this discussion today, along with our friends at SBA and Dan North from Allianz, who is an SFNet member company. The Secured Finance Network, just by way of background, is an 80-year-old nonprofit trade organization whose purpose is to provide the working capital that fuels our nation's economy, and primarily that's to small and mid-sized businesses. We have members that represent large and regional and community banks, as well as independent finance companies and service providers who all together provide these forms of financing to our nation's small businesses. The trade organization provides data and information to help our members and others see around corners on important trends. We educate and provide professional development opportunities for the community. We advocate on issues relevant to our industry at large. We provide referrals to people who have capability to fulfill the financing needs of this community, and we also offer membership to a broad range of participants who care about this, the financing of small businesses. Just a couple of points of context about the size and scope of the secured finance industry. This is a $5 trillion industry that essentially underpins 20% of gross domestic product. There's nearly a million businesses in the U.S. use some form of secured financing, and asset-based lending, which is a product that we work with the SBA to provide to SBA companies, is a big part of that ecosystem, over $500 billion last year alone in that form of financing. And this is the types of financing that these firms use for working capital to fund their daily operations. What's unique about asset-based lending is that aside being extremely flexible to meet a small business's needs, the loss given default is historically extremely low and far lower than traditional bank C&I loans. And it's because of the structure of the product and the type of collateral that underlies it and the terms of the agreements. In the coming year, our objective is to build more partnerships like the one that we enjoy with the SBA and community banks that are part of that network, by providing deal referrals to the extent that there are clients that you're serving that need these types of products if you don't offer the product yourself. If you do offer the product or have an interest in providing the product, we have resources that we can share in terms of companies who have legal expertise and field exam expertise and other capability that's important for delivering this type of solution to your clients. And we're also very focused on attracting talent to this industry, which is such an exciting place to work and such a purposeful place to work. And we do that through scholarship programs at the university level, and also through specialized education programs that we offer to our members and also to the broader community. We host a number of networking events at the national level and at the local level. We have chapters throughout the United States and abroad. And as I mentioned earlier, we provide data and information that you can find on our website that will help you look around the corners, look at key trends that are relevant to this space. If you want to get access to that information, I put this QR code up so you could take a picture of that with your phone. Or you could contact our head of development, James Kravitz, at the address that you see on the screen. So with that, I'd like to introduce Dan North. Dan is the senior economist at Allianz Trade North America. I mentioned that Allianz is a member of the Secured Finance Network. Dan has been with Allianz for almost 30 years. He's an expert at looking at macroeconomic analysis to help with Allianz's own risk portfolio of over 150 billion in annual U.S. trade transactions. Dan has been a frequent guest on major networks, as well as has been quoted in major publications like Business Week, the Financial Times, and the Wall Street Journal. So it is my pleasure to introduce Dan to also help you see around the corner and provide you with context on 2024's commercial overview. Dan?
Rich, thank you very much for that very kind invitation. I certainly appreciate it. And thanks to SFNet for having me and for everybody that's tuning in. And I'm going to bring my presentation up there. And there we are. So I'm going to speak for about 30 minutes on the state of the U.S. economy. But before I do, I want to tell you a little bit about who we are so you can get an idea of how we arrive at our analysis. We are the world's largest provider of trade credit insurance. And the way it works is our clients sell goods and services on open account to other businesses. They hope to get paid back by those other businesses, but they run the risk in that time period of 30 or 60 or 90 days that business will be unable to pay them back. In that case, we cover our clients. We cover them for non-payment. We've been around for over 100 years. We're in 52 countries around the world. We have 5,500 employees and 62,000 clients and a AA credit rating. And there are lots of other numbers on this chart. But the one that I think is important is the one down in the lower left, 1,000 claims indemnified each week. Trade credit insurance is a discretionary purchase. It's not like auto insurance that you have to drive. It's a discretionary purchase. So we have to add value to our clients. And the way we do that is by paying claims. Every CEO I've ever known that comes into this business says we have to pay more claims, which is counterintuitive to an insurance company, but that's what we do to add value. So you can see that we have to have an idea of the probability of companies defaulting, and I do that by analyzing the macroeconomy. So let's start with what's going on that's positive in the macroeconomy, and there are a couple of pretty big ones actually. Right across the top there, consumers, who account for 70% of all economic activity, have been spending and are still spending. That's the chart on the left, personal consumption expenditures. And the columns are the month-to-month growth in spending. And they give you an idea of what's been happening recently. And the black line is the year-over-year rate. That's at 2.7%. That's a little less than long-term average, but it's still okay. And one of the reasons that consumers have still been spending is they have the income to power that spending. This is disposable personal income. And you can see again the columns, the month-to-month, and the black line, the year-over-year rate at now 4.3%, which is pretty strong compared to the historical average of 3.2%. The other things working in our economy are the labor market. That's the chart on the left, and there are a couple of things going on in here. This is what I'd call the headline numbers, and they'll be coming out this Friday. The black line is the unemployment rate, which you can see is very low historically, but it has been creeping up some, very low. The other major headline on this chart is the blue columns. That's the number of jobs lost or created every month. You can see this big spike down when the national economy was closed down for COVID. We lost 22 million jobs. And since then, we've been creating jobs or recovering jobs at the rate of about 400,000 a month. By comparison, to give you an idea how much that is, before COVID, we were creating jobs at 200,000 a month. Now, it's important to understand where these jobs are coming from. You see, if you worked for a company during COVID and that company was shut down, it was counted that you lost your job. Now, let's say the company opened back up the next month. It looks like you've created a job and earned a job. Well, the job was never gone. It was just closed for a month. So most of the jobs in here are those that have been recovered from that national shutdown. Only about 20% of these are newly created jobs. So it's great that the economy is at a low unemployment rate and recovering jobs, but you have to realize we're still kind of below trend where we were. Only 20% of these are new created jobs. Nonetheless, let's say we like the labor market. The other part of the economy we like is the services sector. Over there on the right, the services sector is 80% of all economic activity. And this measure is what's called the ISM Services Survey. It's been around since about 1950. It's carefully watched by economists, and the way you read it is if it's above the 50 level, it means expansion. So the black line is the total survey at 52.7. That's saying the services sector is still expanding. And this survey is broken into 10 parts, one of which is the new orders. That's that blue line. This gives you an idea of work that's coming into the pipeline. It's a new order. Well, that's well into expansionary territory as well. So not only are services expanding, but it looks like they're going to keep expanding. So we've got a lot of things working for us. We've got the consumer spending money, we've got income, we've got a labor market, and we've got a strong services sector. So we think we're going to have positive growth in 2024, but I'm going to go into some things that are a little more negative that'll show you why we think the growth is going to be pretty slow. All right, so what's negative is the inflation, but really it's the Fed's cure for inflation and how it's been damaging the economy. And we'll look at the housing market, manufacturing, freight, and labor market. Now, let's take a look at inflation here. The Federal Reserve, it's their job to lower inflation, and their favorite gauge is what's known as the PCE Core Index. Personal consumptions, so people are buying stuff, and it's the core. It strips out volatile food and energy prices because the Fed can't really control what's happening in the Middle East, and they can't really control the weather that lowers or raises food prices. So they strip that out to get a little better feeling of what the underlying inflation rate is. And right now, that black line is saying inflation's running at 2.9%. Not quite the 2% target. But you can look at inflation at any sort of time period, like in the middle, there's this inflation over the past 6 months at 2%, or the blue line in the right-hand chart, over the past 3 months, 1.5%. Again, the target the Fed is shooting for is 2%. So over the last 3 and 6 months, it's doing well on that. The measure they want at 2% is the year-over-year rate. We're getting there, but not yet. So tomorrow is the Fed meeting, and they're going to come out with caution and say, our job is not done. We're not at 2% yet. So this is the Fed's measure. There's another measure that most people look at as the headline measure of inflation. And it always runs a bit hotter and is thought to be a bit more realistic. It's called the Consumer Price Index. And again, this is the one that people would look at the most. And the CPI peaked in June of 2022 at 9.1%. That was a 40-year high. That was really kind of shocking at the time. Well, since then, the Fed has done a good job and has driven inflation down to 3.4% year over year. And that's a good thing. It is. It's a good thing. But just because the curve is going down doesn't mean prices are going down. Prices are still rising, just at a slower rate. They're still growing at 3.4% per year. And also think about it this way. Okay, we peaked at 9%, and then we crept down to, I don't know, 8.5% and 8% and 7.5% and 7%. Those are still really high inflation numbers, and it's cumulative. These inflation numbers add on. And so if we go back and look at January of 2021, when inflation really started to pick up, that's the chart over on the right. And what it shows is cumulatively wages, that black line, have risen 15%. But the things that wage earners need to live, like food, housing, and gasoline, have all risen much faster than wages. Wage earners are still underwater from January of 2021. Sure, they've made gains over the past number of months, but they're still underwater, and that's why things still feel so expensive. They are. Prices are still high. Wage earners are underwater. Well, Federal Reserve realized inflation was getting out of hand. They realized too late, and they realized wage earners were getting underwater. So they went on the most aggressive inflation fighting path in the modern era. And that's what the chart on the left shows. Now, everybody says the Fed's raising or lowering interest rates. And I say the same thing too, because it's very convenient. But really, the Fed only controls one interest rate. That's the overnight Fed funds rate. And that's what it uses to influence the economy. And that's what these lines are. Each one of these is a beginning of a tightening cycle back in time. And you don't have to look at what they all are. You only need to look at the red one, because that's 2022 and 23. It shows by far that this is the most aggressive hiking cycle of the modern era. They started late and they saw inflation was running out of control and wage earners were behind. So they got very aggressive. Now, question is, have they become too aggressive? And perhaps so. And if we look at the text over here on the top right, take into account it takes 3 to 5 quarters for an interest rate hike to have full effect on inflation and the economy. So much of the recent hikes have yet to have a chance to have full effect. So let's look at this sort of conceptual diagram here. This is shaded area is inflation in the economy, and each one of these red arrows is an interest rate hike. So the first one was in March of 2022. That's been coming up on 2 years ago, certainly more than the 3 to 5 quarters. So it's had its full effect on the economy and inflation. Same thing with the May 22 and the June and July 22 hikes. Certainly more than the 3 to 5 quarters, they've had their full effect. November, December, well, that's that's just over a year ago. Maybe that's not the full 5 quarters. Maybe it hasn't had the full effect yet. January, March, May, July, all of those interest rate hikes have not had their full effect yet on inflation. So, you can see that it has driven inflation down, but they haven't done the full effect. And in the meantime, they have hurt the economy, and we'll look at these 4 sectors to see how the interest rate increases have hurt the economy. Now, the first sector to suffer, to the first victim of the interest rate increases, was the housing market. The chart on the left shows that vertical line there. That's when the Federal Reserve finally came out and said, we've been saying all year that inflation's transitory, that it's just a matter of supply chain or labor shortage. We've been saying that all year, but finally in December of 2021, they said, well, I guess that what we were calling transitory inflation is not really transitory. Now, that sends a message to the financial markets. The Federal Reserve is about to start raising interest rates. And when it did, that's when this 30-year mortgage, the black line, started going up rapidly from 3% to over 7%. And over that same time period, existing home sales, the blue line, fell by 37%. So there's a very direct correlation between when the Fed signaled we're going to raise rates, mortgages go up, housing activity plummets, and it's never come back yet. All right, so we have high mortgage rates. In the meantime, on the price side of the housing market, COVID drove up prices dramatically. This is a price index, go them up dramatically. Now it's gone back up and forth recently, but this is where we are now. And it's way above pre-COVID levels. It's 50% higher than pre-COVID levels. So now you have still high housing prices, very high mortgage rates, and you combine those two, you get the affordability index. That's the chart over on the right. It takes into account the price and the mortgage rate. And the lower that line goes, the less affordable housing becomes. And you see it's at a 38-year low. And this is why it's going to be a while before the housing market recovers. It's just so unaffordable now. Now, the second sector which was affected by the interest rate hikes was manufacturing. Manufacturing's interest rates sensitive. If you're a corporation buying a big piece of equipment, you borrow money to do it, or people borrow money to buy cars. So it's interest rate sensitive. And here's some measures of the manufacturing sector. On the left, this black line is new orders for durable goods. These are orders like that are for big goods, last more than 3 years, like appliances, washers, dryers, that sort of thing, getting up to as big as cars and automobiles. These are the big items, and these are new orders. These are the things that are coming into the pipeline that will provide employment going forward. Well, you can see that's dropped off pretty sharply. The blue line, that's manufacturing, industrial production. That's just a measure of everything that comes out of the factory door. And you can see now that's actually shrinking at 0.8% year over year. And by the way, this manufacturing industrial production number is actually divided into something like 60 or more sub-indices. And right now, 64% of them are negative year over year. And on the right, two last measures of the manufacturing sector, going back to this ISM survey, which when it's below 50 means contraction. Well, you see the black line, 47.4. That's below 50, saying manufacturing is in contraction. The blue line, new orders at 47.1. New orders that are supposed to bring business, economic activity in through the pipeline, they're in contractionary territory as well. So there are 5 measures right there that are in contractionary territory, and they don't turn around very quickly. These are in contraction, this is in contraction, this is very slow. These are new orders, giving us an idea of what's coming. Now, manufacturing is tightly related to the freight industry, because if you look around the room where you're sitting, just about everything that came to you that's manufactured. I'm looking at a lamp and a desk and a laptop. All that was manufactured, and it came to me mostly by truck. Came to a store by truck and then to me. So freight is very tightly related to manufacturing. It's a very good leading indicator. And the chart on the left shows trucking expenditures. And you can see it's down 28% pretty dramatically since the Fed signaled it was going to raise interest rates. What else is interesting here is when that measure of trucking expenditures fall, it's followed by this gray column, which is a recession. So it happens here and was happening before COVID. I'll show you charts like this a fair amount. Those gray columns are where there have been historically recessions. Another measure of freight is shipping containers on the right, again, falling off pretty dramatically. Finally, we're starting to see in the labor market an influence of increased interest rates. Now, at the beginning of this presentation, I said, gee, the labor market's great. It's one of our strengths. You know, we're growing jobs, low unemployment rate, et cetera, et cetera. Fine. Those are the shiny headlines. Underneath them, there is some degree of decay. So, for instance, the chart on the left shows the growth rate of new job creation. And that peaked out at February of 2022 at 5.2% and has been steadily declining every month since then. And come Friday, we'll get the new employment report and it'll decline again. And this is typically what you see happen just before a slowdown. You're still growing jobs, but at an ever slower rate. Now, the chart on the right is data that came out this morning, and the black line, for instance, is data about people that quit their jobs. It was in the millions here in the peak just after COVID because people were desperate for workers. So workers could quit their job and get another one very easily. The quits rate was very high. Now that's come down to pre-COVID levels. It's fallen 16% in the last year. So you see some decay in the labor market there. And the blue line is the number of job openings that employers are putting out there. And that's down very sharply as well. There are a couple of other things that we'll look at on Friday. Temporary job growth there on the left. Now the blue line is growth in temporary jobs, and you can see every time it goes negative, it's followed by a recession. Happens here, 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 and here, and now we're very sharply negative as well. So these columns are historical recession. We're not saying recession. That's not our forecast. We're saying a sharp slowdown. But I want you to see these patterns. Another measure in the labor market is this consumer confidence survey. It's a phone survey where they call people up and ask them, well, are jobs plentiful or they're hard to get? Well, in good times, the blue line goes up. People are saying jobs are plentiful. They're not so hard to get. But when that blue line goes down, it means people are now saying jobs aren't so plentiful. Jobs are hard to get. You can see every time that blue line peaks, people start changing their answer. It's followed by a gray column. Happens here, 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 and we peaked some number of months ago here as well. Another measure, finally, is jobless claims. This is where, suppose the business you work for went out of business or the building burned down or you just got fired. This is where you go in the unemployment office and say, hey, I am out of job. I need some my unemployment benefits. That's what the blue line is. It's the number of people every week that go in and get jobless claims. And in good times, again, fewer and fewer people are making claims for unemployment. But when it bottoms out and goes the other way, more and more people are making claims for unemployment, followed by a recession historically. Here, this is now a 50-year chart. So it happens here, 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 and we did bottom out last September. Now this takes a while. It gives you lots of warnings. So the fact that we haven't had the slowdown yet by this is not really surprising. It takes a while for this trigger to go off. So I think I've got a case where there's, decay in the labor market. Underneath, there's jobless claims and temporary work and, the consumer confidence survey and these other measures. And, we're going to get the Friday employment report that shows job growth. I think that there's decay underneath, and that as a result, we're going to have a soft year in 2014. Well, people say to me, hey, what are you talking about? We're going to grow 160,000 jobs this month. And we grew, I can't remember the number, a whole lot more than that the month before that. What are you talking about, a slowdown? How can that be? And the answer is, that's the way it works. Labor is the last pillar of the economy to fall because no employer wants to let somebody go unless they really have to. And this is the historical record shown on the right. Each of these lines is a different recession. You don't have to figure out which ones they are. And they're plotted 12 months before the recession. 0 is the month the recession starts and goes out 12 more months. And it's plotted against the number of jobs created. Now, the point is 12 months, 10 months, 6 months before the recession, all of these recessions are still creating jobs. They're still in this positive green box, still creating jobs right up until the month the recession starts. And then they drop off, and that's when you get the job losses in this orange box. The point of the chart is, again, labor is the last pillar to fall. The point that you got a good jobs number last month tells you nothing about what's going to happen next month. I showed you some other leading indicators that did. Here's some others. One of them is one of my favorites, and a lot of economists' favorites, is what's known as the yield curve on the left, that blue line. That's just the difference between the 10-year Treasury note and the 3-month Treasury note, long-term and short-term interest rates. So let's say over here it's plotted at 200 basis points. That might be a case where you have the 10-year at 3% and the 3-month at 1%. The gap there between the 3% and the 1% is 2%, or 200 basis points. Now you can see, if you squint your eyes, you can see that blue line representing that gap is almost always positive, which makes sense because if you're going to lend money for 10 years, you'll demand a higher interest rate than for 3 months. So that's why it's positive most of the time, except for times like now, when the Federal Reserve has been jacking up short-term interest rates to the point that they become higher than long-term interest rates. And that gap becomes negative. That blue line goes negative. And every time it does, it's followed by a recession. So again, we're looking at a 50-year chart. It happens here. Blue line goes negative here, recession, negative here, recession, negative here, recession, here, here. And we recently set a record low with the yield curve here. Now, another important part of this chart is the length of the red arrows. That's the warning that it gives before the recession. The blue line goes negative, and then there's 3 to 5 quarters before the recession actually starts, typically. So it gives you plenty of warning, and that's what we're seeing. It's a very strong indicator. And this is run by the bond market, is what sets interest rates. And when the blue line goes negative, it's the bond market saying, hey, Federal Reserve, you already went too far. You inverted the yield curve. On the right is when consumers tell the Fed that they've gone too far. This is the Consumer Confidence Survey, another phone survey, where they ask people, how are things now and what do you feel about things in the future? And when times are good, people say, oh, I think things are pretty good. And I'm not so worried about the future. When times start to go bad, that's the divergence of the blue line. That means more people now are saying that they're worried about the future. When that bottoms out, more people are starting to worry about the future, it's followed by a recession. Here, 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 and we recently hit the lowest one of the lowest in 56 years. When it bottoms out, that's when people are starting to say, I'm really worried about the future, and they're right. Now, so I've got what I think is a good argument for a slowdown, but hasn't come yet. A lot of economists have been the same way. We think that there was a slowdown coming and it's not here. Why not? What's different about it? Well, there's several reasons. First of all, there's that 3 to 5 quarter lag between changes in interest rates and how it affects the economy. So we'll go back to this chart, which shows the separate interest rate hikes affecting the economy and inflation. And we see that not all of them have had enough time to have full effect. Now, this chart on the left is the Federal Reserve raising interest rates. It's one of the two tools that the government has to manage the economy. That's the monetary policy on the left, that's run by the Fed. Fiscal policy is on the right. It's budget outlays. You don't have to look at all the columns. You can just see that budget outlays took a big leap at COVID, and they're just never going to go back down. So while the Fed is trying to slow the economy over here, the government, the administration and Congress is just is doing exactly the opposite, flooding the economy with money. So the Fed's actions have been stymied by fiscal policy. So they've gone head to head on this. That's one of the reasons that monetary policy has not had its full effect. Another way to look at it is we look at the real federal funds rate. That's the Fed funds rate after inflation. Now that's the blue line there. And if we go back in, again, a 60-year chart, we can see the level of the Fed funds rate, the real Fed funds rate associated with recessions. And you can see we're not quite there yet. As inflation continues to fall, this blue line will keep going up. It's the real Fed funds rate after inflation, and will reach levels that historically have triggered a recession, in this case, a slowdown. And also over on the right is another example of how the Fed funds rate has not become quite restrictive enough. It's the difference between GDP and Fed funds rate, and you see it goes negative. That's when you get the recession. Not quite there yet. So that's one set of reasons. Another set is debt here. Corporations, when the Fed had interest rates at 0% in here, a lot of corporations locked in debt at 0%. They issued a lot of debt at 0%. In fact, their interest payments, the blue lines, at a record low. So it's like they're sitting there saying, Federal Reserve, go ahead. Raise rates all you want. We locked in. And it's not affecting us. And the same thing happened with consumers over on the right. If we look at the blue line, this debt service ratio, it's the amount of mortgage payment and consumer debt payment compared to your income. And you can see it's very, very low because consumers did the same thing. They locked in low mortgage rates. So it's like they're saying, Fed, go ahead, raise rates all you want. We're going to hold on to our fixed rate mortgage. So that's another reason why monetary policy hasn't had its full effect yet. Okay, so what's coming next? What's coming next? Well, let's look at the most important part of the economy, the consumer. And the consumer, which has been doing so well, is now going to be facing headwinds. And one of the headwinds is a drop off in income. This black line, the year over year number, I showed this early on, growing at 4.3%, pretty strong historically. Well, that was bumped up in last January by this big increase in Social Security cost of living adjustment, 9%, and that has carried that year-over-year rate all the way through. Well, guess what happens next month? Social Security is not going to get that big an increase, and this growth rate of income is going to drop off. Okay, so income's dropping off. Where are you going to get the money to spend now? Well, you go into savings. That's the chart on the right, but you can see savings are dwindling away as well. All right, no income, no savings. Now where do you go to get money to spend? Well, now you go to credit cards. That's the chart on the left. That's the amount of credit card debt. It's gone up 37% in the last 3 years. And it's gone up at an outrageous interest rates. That's the chart in the middle, the record high interest rate of 21%. And that's what can I say? That's a rate that's ridiculously high. If you got a lower credit score, then it's even higher than that. And this combination of a lot of debt and very high interest rates is leading to an increase in personal delinquencies. Now, it's not a record high, but it is going the wrong way. So these are the things that the headwinds that the consumer is facing. One last thing to consider is that the Federal Reserve, which has been slowing the economy, slowing inflation with monetary policy, as it should, always historically has kept raising rates until something breaks. And that's the chart over on the left. The red line is the Fed funds rate. We go back to the late 80s. The Fed raised rates until burst the savings and loan crisis, and then raised into the tequila crisis and the dot-com bust and the global financial crisis and the repo crisis. What is, we think for us, what we know is for us, what's going to break is bankruptcy filings, because that's our business, is to ensure our clients that other businesses they sold to won't go bankrupt. Now, the blue columns are the number of bankruptcies filed from the 80s till now. And the only other thing, you can see it's gone down steadily over that time period. The only other economic variable that's done that is that line, the 10-year interest rate. Well, now you see that rate backed up, and now bankruptcies are going up. And as of Q3, they're up 30%, and we think they're going to be up 50% when everything's said and done, and another 15% next year. Those are huge numbers, percentage numbers. Fortunately, they're off a really low base and bring us back to previously low levels. And we're in a position to manage that very well. But that's what we see breaking as the increase in bankruptcies. Okay, I'll wrap up here. We do have some really good things working for the economy, but we still have inflation hurting the housing market, manufacturing, freight, labor, consumer outlook is poor, and it's because the Fed started so far behind, and they've had to be so aggressive in their interest rate hikes. And we think that in 2024, we're going to see very slow growth coming up. Positive, but very slow growth. All right. Thank you very much for your attention. At this point, I'm going to hand it back over to Claire, I think, and we're going to go to question and answer.
Great. Wow. Thank you so much, Dan. And yeah, it's true. It's really great to hear from you. Just, talking to economists, you definitely help us understand some of these, just all the data behind those shiny headlines. And so thank you very much for that.
Sure.
I do. So given this, I think I want to ask a question of both of you, maybe Dan first and then Rich. So how is this going to impact accessing credit, right? So for businesses, right, who are looking for credit, how are these economic trends what are your top concerns about impacting access to credit in the next year? Maybe Dan, you first and then Rich.
Sure. I think actually access to credit is going to get a bit easier. We were very worried last year when the Silicon Valley Bank collapsed and credit conditions tightened very sharply. That crisis turned out to be very manageable. So that fear has gone away. Now we're seeing the very high likelihood of interest rate cuts in 2024. Financial conditions are already easing a little bit. So we expect to see later in 2024 easing of credit. Not right away, but we think things are going to be easier next year.
So I'd agree with that. But just one quick thought is that asset-based lending is a little different than traditional loans in that it's kind of an all-weather industry. So that when we saw the cost of debt go up so significantly for companies over the last year or two, that put a lot of pressure on businesses that used to be able to borrow unsecured. And so they turned to asset-based lending and other forms of secured financing to get access to capital. When it goes the other direction and you start to see economic expansion, that drives demand. But even without expansion, and I think Dan's points about it's going to be a low growth environment makes sense. There are still other opportunities because when companies merge, there's M&A activity, there are other restructuring activities. Those result in recapitalizations of those businesses, and that's an opportunity to provide financing. So asset-based lending, I would say that form of capital is going to still be plentiful. I think that traditional bank loans, we've already seen tightening.
Richard, I just want to keep on you for a minute and ask you, right? So what barriers do lenders face when they're trying to add asset-based lending financing into their product lineup?
Well, it's not, it's a different form of financing. And I guess what I've seen in different cycles is that companies who get into the space, the biggest mistake that they would make is they offer something that we would call ABL light. In other words, they're not doing the full monitoring that takes place on a traditional asset-based loan where you're looking at inventory and receivables on a very frequent basis, and the borrower draws against a borrowing base that's reviewed constantly, and it's and there are field exams and there are other methods that you can look at analyze that base, and without having that expertise, there are real risks that people could experience. So I would just say if you're going to get in this space, there's a couple of ways to do it. One is the referral method that I mentioned, that there are companies in our industry who can do this and work with you, and you can keep your clients and you can learn how to introduce this product. And then we also have resources to help people understand how this all works. And we've got service providers who can do some of these things for lenders who want to get into this space.
Great, thank you. So we have a question about, and I'll ask again, maybe we'll go first to Dan and then back to Rich. Just as large corporates and mid-sized businesses reorganize their supply chains, right, either nearshoring or trying to reorganize to make their supply chains more resilient, what opportunities does that create for small businesses here in the United States?
Well, that I think would actually fall more back into Rich's lap. I wouldn't have a really good answer on that, I'm afraid. But I will say one thing: this idea of reshoring and building new supply chains is great. I think we realized that we, as a country, were exposed during COVID. Our supply chains could easily be at risk. They take time to build. And when they do, it's going to be inflationary because we're going to have less access to countries where there's much lower labor rates. So that would be my macro answer. I'm going to throw it back into Rich to see.
Well, then you may also get into a situation, depending on what happens in the next election cycle, you may have tariffs that come into play on some of that too. So it's so there are a few questions relating to how that's going to work. I do see the opportunity, and I can't point to specific companies that are thriving as a result of this onshoring trend or nearshoring trend, but I know that it is an effort that's been underway since the pandemic among the borrowers that our lenders are supporting. So I know that it's been part of their business plans, and so that activity is happening.
Great. Well, thank you. So, okay, so now this can be for either of you who want to answer. We have a question about the regulatory environment. And so and really, in particular, how does the regulatory environment affect SMEs and their lenders? And do you want to have any comments on what Basel III could have?
I could start that one, Dan, if you
Yeah.
like. I mean, this is something that SFNet gets very involved in. We sent a very detailed comment letters in regard to Basel III. We worked with other trade groups like the American Banking Association and others. In fact, there's been such a reaction to the Basel III new rules, the proposed rules, like nothing I don't think I've ever seen. When you're watching Sunday Night Football and you see an ad for the Basel III Endgame, you kind of feel like this thing has taken on a life of its own. But the ripple effect of these rules, and I'll speak as they affect secured lending. These products historically, I mentioned, have very low loss given default. And the new rules would have taken away capital treatment benefits that would allow companies that provide these forms of financing to have a lower cost of capital. With those being taken away, the cost of borrowing to small companies and large companies will go up significantly. And that has a ripple effect because it's not just the biggest banks that would be subject to Basel III. When those borrowing costs or lending costs go up, the lending costs go up. Those are also projected on the companies the independent finance companies that borrow from the banks in order to get capital. So it cascades through the economy. And so I think that's generally a negative. We also see an awful lot happening at the state level in terms of disclosures and other things, which we believe are well-intentioned, but they overreach. And that happens a lot with regulations. They tend to overreach, and then they got to work their way back. It's a pendulum. So we're hoping it moves in the right direction, but there are some risks for sure.
Yeah, I just mentioned quickly because I think you're more on top of it than I am. This is the nature of regulation. It's well intended, let's mitigate global risk and so forth. But it does have some intended and unintended consequences. We're trying to, minimize risk in the financial system, but there's a cost to that. And that gets overlooked by regulators who just want to, for instance, minimize risk, minimize the possibility of the next financial market meltdown. There's a cost to it, and those costs eventually always get down to the consumer, and they become more or less a tax. So I think that there's that consideration, and from what I know of those regulations, they'll bring you to tears trying to figure out what they are. So and I'm curious about what you saw in the football game and Basel III. What was that?
Basel III Endgame. It's a lobbying group that was trying to activate the public to talk to their to the regulators or to their congressmen or anybody else who they felt like could affect the outcome of Basel III. So they went broad. And I can't even remember the score of the game.
Well, I think we're actually at time, and so I'm gonna stop the questions. But I just want to thank both of you so much for this commercial outlook. Like I said, when you're armed with data and sort of better understanding about the economy, I think that, that's really what is so valuable about this kind of commercial outlook. And I know, Dan, like these are predictions, right? But right, and we don't act, sort of like the future will unfold the way it unfolds. But I think I want to thank both of you and just for this analysis. Again, thinking about 2024 and some of those sort of major drivers that are going on in the economy. So I want to thank you so much from the SBA side. Again, we hope to provide this kind of information, especially for SMEs and entrepreneurs. We hope it's helpful for you on your growth journey. And if you ever want to do any follow-up with the SBA, you can find us on sba.gov/international. Now I think I want to turn it just back over to Census, and we really want to thank the Census for hosting us today. And I'll turn it back over to you.
Once again, we'd like to thank you for your participation in today's webinar and issue a special thanks to the team of speakers, staff managing the question and answer, and the businesses that joined today for sharing valuable information on the 2024 commercial outlook for businesses, banks, and international trade. A wealth of information was provided today, and I believe you received several takeaways from the discussion. For future outreach events, please visit the Census website at census.gov/foreign-trade, which has also been provided with the link located in the chat. Please complete the short evaluation as you exit the webinar. Your feedback is very important to us and assists in planning future webinar content. If there are no additional questions, this completes the webinar for today, and thank you for joining the webinar. Have a good afternoon.
Thank you.
Concludes today's session. You may disconnect at this time. Have a good afternoon, everyone.